Alright, let's get right into it. Welcome to today's explainer, where we're breaking down a strategy that is an absolute game changer if you're tired of overcomplicated charts. I mean, if you've ever felt totally overwhelmed by screens just cluttered with moving averages, RSI lines, and complex algorithms, you are definitely in the right place. Today, we're zooming in purely on price action. We're going to unpack a beautifully simple, rule-based, indicator-free method called the 4-hour range scalping strategy. We'll be digging directly into the data and chart setups provided by the popular channel Data Trader, so we can see exactly how this system holds up across a bunch of different asset classes. Now, you might be wondering, how in the world can a single 4-hour candle completely dictate every 5-minute trade for an entire day? It sounds kind of counterintuitive, right? As day traders, we're usually taught to constantly scan a million different timeframes and overreact to every little market twitch. But what if you didn't actually have to do that? What if one single candle could give you a complete, reliable roadmap for the whole day without hours of prep work? Well, that's exactly what we're going to figure out today. By isolating just one specific candle, we can set up crystal clear boundaries that tell us exactly when to jump in and out of fast-paced 5-minute scalps. So here's our game plan for this explainer. First, simplifying the 4-hour time frame. Second, the 3-step entry process. Third, handling large breakouts. Fourth, facing losing streaks. And finally, number 5, a trade performance summary. Okay, jumping into section 1, simplifying the 4-hour time frame. This is where we establish our baseline. The absolute foundation of this whole thing is what we call the 4-hour range. Simply put, this is just the exact distance between the highest price and the lowest price of the very first 4-hour candle that forms in your trading day. This isn't just any random candle, guys. This is our ultimate boundary line. Think of it kind of like drawing the out-of-bounds lines on a soccer field. All the meaningful action and all of our specific trade triggers are going to revolve entirely around how the price interacts with these top and bottom boundaries for the rest of the session. Now, the rules for this are incredibly strict, but that's what makes it work. First off, you've got to set your chart's time zone to New York time. This just guarantees consistency, especially when you're looking at 24/7 markets like crypto. Next, you isolate only that very first 4-hour candle of the new day, period. And here is the absolutely crucial part that requires a ton of discipline. You have to wait for that candle to fully close. If that candle is still forming, you literally just sit on your hands. No drawing lines until that 4-hour window is completely finished and the price is locked in. Patience here is the basically non-negotiable. Moving right along to section 2, the 3-step entry process. Let's look at how we actually execute this. So the crazy part is just how mechanically simple this execution really is. Step 1, like we just talked about, is marking the exact high and low of that closed 4-hour candle. Step 2, you drop all the way down to the 5-minute time frame. You're waiting for a 5-minute candle to completely break out of your 4-hour range and close outside of it. Then you wait for the price to reverse and close back inside the range. Step 3, the literal second it closes back inside, you enter the trade, and you set your risk to reward ratio at a super strict 1:2, meaning whatever amount you are risking, your target profit is exactly double that. But hey, let's clear up a few common pitfalls right now, because the devil is always in the details. When you're dropping down to that 5-minute time frame, the candle must fully close outside your boundary. If the price just pokes out but leaves a long wick and closes back inside on that same candle, no way, that's invalid. Wicks alone do not count as a breakout. You need a definitive full-body close outside. Also, all of this, the breakout, the return, the entry, it all has to happen within the exact same trading day as your anchor 4-hour candle. If this setup spills over into the next day, scratch it, the setup is dead. Just to make the directional logic super clear for everyone, if the price breaks above your 4-hour high and then a 5-minute candle closes back down inside the range, that's what we call a fake out to the upside. So you enter a short trade, betting the price is going to fall. On the flip side, if the price drops below the 4-hour low and then a 5-minute candle closes back up inside the range, that's a fake out to the downside. You enter a long trade, betting the price will rise. It's really just a classic mean reversion setup, making a profit off of failed breakouts. Alright, section 3, handling large breakouts, because the market rarely plays perfectly nice, right? So normally, your standard stop loss goes at the absolute extreme high or low of that 5-minute breakout move. Makes sense, but what happens when the market goes a little crazy and prints a massive, sweeping 5-minute candle? If you place your stop loss at the extreme edge of a huge spike, your risk zone becomes massive, which means hitting that 1-2 target profit is going to be unsustainably difficult. In these messy reality scenarios, you have to adapt. Instead of the extreme edge, you look slightly inward. You place your stop loss at the nearest logical key level, like a minor support, a resistance zone, or maybe an order block that formed during that big move. Data Trader actually highlighted this perfectly in their analysis, saying, for these types of scenarios, instead of using the exact low of the range, I looked for the nearest key level to place the stop loss. This is such a crucial takeaway. Even the most rigid, strictly rule-based systems need a little bit of logical adaptability when extreme outlier volatility hits the market. You've got to protect your capital smartly, right? You don't want to just blindly follow a rule right off a cliff. Which leads us to section 4, facing losing streaks. Let's talk about the psychological side of things. Let's look at a radically transparent, real-world example from a gold chart. Imagine this. Morning session, a perfectly valid short setup appears. You take it and bam, it hits the stop loss. That's a 1R loss, meaning 1 unit of your risk is gone. Later that afternoon, a second valid setup shows up. Again, you follow the rules perfectly, and again, you get stopped out. Another 1R loss. You're now down 2 full units for the day. Honestly, a lot of traders would just panic or quit right there. But then, in the evening, a third valid setup presents itself. You take it without hesitating, and this time it smashes the target, giving you a 2R win. And that right there, that illustrates the absolute mathematical beauty of this strategy. Because you are so rigidly enforcing that 1 to 2 risk-to-reward ratio, that single winning trade in the evening completely, 100% wiped out the 2 consecutive losses from earlier in the day. You essentially ended the day at break-even, even though you only had a 33% win rate for that specific session. This built-in mathematical edge protects your account balance, sure, but more importantly, it protects your sanity during those inevitable losing streaks. Okay, final section, section 5, trade performance summary. Let's look at the actual numbers. Across multiple, totally different markets, the back-tested results for this strategy hold up remarkably well. Look at this. In Bitcoin, 7 setups yielded 5 wins, netting 8 units of profit. In Forex, specifically the Euro/USD, 6 trades brought in 5 wins for 9 units of profit. And even in gold, which is notoriously choppy, 10 trades resulted in 6 wins, still generating 8 units of profit. It really proves that solid price action is universal. Breaking that down a bit more, in the crypto sample, we're looking at a highly impressive 72% win rate. Bitcoin actually often respects clear consolidation ranges really well, which makes these fake-out setups highly lucrative if you're a disciplined scalper. Moving over to Forex, the Euro to US dollar pair saw a massive 83% win rate in this test. Since major Forex pairs often range pretty tightly before macroeconomic news drops, using the first 4 hours of the New York session creates a super reliable boundary for the rest of the day's volume. And finally, gold. Now, even in a highly volatile commodity market that is literally known for aggressive sweeps and erratic behavior, this system still maintained a profitable 60% win rate. And remember, because of that 1 to 2 risk-to-reward ratio, a 60% win rate is actually incredibly profitable over the long run, easily absorbing those 40% of trades that stopped out. So what does this all mean for you? Well, the mechanics of this 4-hour range scalping system are, as we've seen, incredibly straightforward. You mark the highs and lows, you drop to the 5-minute chart, you wait for the fake-out, and you manage your risks strictly. But the real challenge? It isn't the strategy itself, it's you, the trader. Do you have the extreme patience and emotional discipline to just sit on your hands, tune out all the noise, and execute your trades based solely on the boundaries of one single candle every single day? It's a tough question, but if you can master that level of patience, this could very well become the most powerful tool in your trading arsenal. Thanks so much for hanging out with me for this explainer. Keep your risk managed out there, and I'll see you next time.